What's up? So I want to talk about a new form of finance that doesn't require you to get a credit check, doesn't require you to have 3 years of tax returns and financials, which most banks are going to want you to have, is not going to be based on your net revenue. And with all that said, it is going to be expensive, but you get access to up to $1 million. And we were looking at financing a transaction that we are doing in a business. Since we were doing promotions with this Facebook group, and we kind of paying them. We're like, okay, this thing's growing really fast. The audience is perfect for what we're selling. We know we're going to be paying them for, as long as it continues to grow like this and work so well. So let's see if we can just buy this thing. So we went to them, came up with a deal structure, and then we went to figure out, okay, where do we want to get the money to buy this? And as much as possible, as you guys know, I like to, for the business that I'm running, for it to be its own entity, its own LLC, separate from me, separate from even the investors, that is able to get access to capital, whether that capital is equity, loans, other forms of financing like the one I'm going to talk about today. We want that to be its own thing. And one of the mistakes that most sole proprietors make, and just most entrepreneurs in general, is they tie themselves up in the business by signing on the dotted line for personal guarantees and things like that, where everything's really based on them. It's based on their credit. It's based on them putting in their own cash even. And so we want to stay away from that, whenever possible. So we're trying to figure out how we want to finance this. We could go out, we could raise some equity. And one of the leads on the business basically said, hey, we keep getting this offer from Stripe to get access to their financing. And I'm like, okay, yeah, let's check it out. So we checked it out and learned a little bit more. And one of the cool things is they literally will finance up to $1 million. But the really great thing for us was it's 100% based on the business. And the truth is, I will pay a little bit more for capital if it's loaned directly to the business. I'm not tied up in it. None of my partners have to be tied up personally with that being reported to their personal credit report. Just all those things, because those things can have an impact. If I have a lead on a business and then they're taking a personal loan for that business, now when they go to get a car loan because they want a new car, or they go to get a loan to buy a house, this is going to impact what their rate is going to be and what they're able to borrow. So you're paying for a service, and so that's in this case it'll end up being about 12%, but it's worth it from that standpoint. More importantly, it's worth it if you're getting an ROI. So in this case, we're literally spending a few $1,000s a month, and this is going to allow us to buy that asset that now we don't have that expense, and instead we're building equity in this new asset that essentially, once we're done paying for it, we're never going to have to pay that $3,000 a month in advertising. So well worth it from an ROI perspective. Now, let's talk about how this loan works and accessing it. And when it comes to thinking like a financier in your businesses, you want to make sure that you're accessing capital, you understand what the cost of that capital is going to be, and then you're deploying that capital in a place that's going to get a higher ROI. It's really that simple. Now, one of the things about this that, it could be a downside is that they're taking out money daily as a percentage of your transaction. So a normal loan, you're going to pay every month. With this type of loan and what Stripe is doing, they're going to take out a little bit of money every day based on the percentage that you agree on that they can take out towards repayment of that loan. So that gives them a little bit of security. Another thing to be aware of is they want 6 months of history. So they want you to have 6 months of doing business, preferably at the same amount. And I feel like the minimum they're looking for is maybe 20,000 in transactions, but that's just gross. Most of the businesses that are going to be for sale, even if you've got a business that is making whatever 60,000 a year, typically the revenue is going to be a lot higher than that. So they want to see that 6 months of history. So typically, one of the things that I like about it is when you're going to another institution, you're going to a bank and you're gonna basically get a loan, they're gonna base it off of your net income. And so they're gonna look at your past 3 years of tax returns. They're gonna say, okay, you're making this much net, and this is what we can loan you based on that. Here's the problem. The average entrepreneur is counting everything against their revenues to show a minimal net income because you don't want to pay a higher rate of taxes. So when you're going to get a different kind of loan or normal loan, as opposed to this, it's going to minimize what you're able to access. If, on the other hand, you go and access a loan that's something like this, in this Stripe Capital deal particularly, they're not paying attention to that. And this is a pro and con. So the pro is they're looking at your revenue because they're going to take a percentage of your revenue and they have your revenue. So they're not worried about you, quote unquote, being able to pay. But the truth is, you need to be worried about if you're going to be able to pay. And here's the reason. So let's say your profit margin is 20%, but you agree to give Stripe 15%. That is a very small margin of error that you now have in your business. So the real key to this, and what I would say is, this isn't a great strategy for e-commerce businesses. Unless it's an e-commerce business with some very strong margins where, 60% plus gross margins is probably where I would want to be. This is a great strategy, however, for SaaS businesses where you don't have that cost of goods, the cost of shipping, the cost of returns, all those things that eat into your margin even after you purchase the good to sell. The other business that I like a lot for this is businesses where you may be doing mentoring, you're coaching, things like that. And this is something for you to think about, is getting your revenue coming through one of the entities that offers something like this. And I'll talk a little bit on another video even about how PayPal's deal works. But when you build up that history, you're building up the ability for your business to borrow. And I love those businesses where you can take a certain dollar amount because, when I'm looking at this, I want to take that capital, like I said, look at the cost, be able to invest it and make the difference in just the classic financier style where capital costs me 10%, I make 30%, 20% spread, and I want to do that until it doesn't work anymore. And that's how you scale. You can grow infinitely with that kind of strategy and literally only be limited by the amount of capital that you're able to access. Now, one other quick bonus on this that personally I love, because the other thing I'm always looking at is, I want to get those returns, but then I want to minimize the amount of taxes that I'm paying. And one of the cool things about this is if you have a business that is with a company like Stripe and you do one of these loans, when they report your taxes, they actually deduct those payments. So if you are paying 15% to them, they don't report that income at all to the government. So you contrast this with a loan where, you know, you're going to have this total amount of revenue, and now you've got to, you know, not necessarily convince, but go to the government and say, okay, I paid this loan, and then I want to deduct that. You know, basically, it just cuts out that whole reporting. Just a nice little benefit that you don't even have to worry about trying to deduct that loan. It just comes right off the top. It's never, that income is never reported to the IRS. So a cool little benefit there. Now, the things to remember on this is, you know, you do need 6 months. I do think that this is something that a lot of people in acquisitions kind of look over, not just as a way to acquire other businesses, but also to reinvest in the business that you do acquire. And then I think that there are going to be some cool strategies you can use, even to offer financing to other people when you're selling a deal as well. So hope this video was valuable for you guys. Very neat. I think a lot of these things are going to be popping up where there are alternative forms of financing. They're becoming more attractive now. You know, I go back and I look at some of the things that we passed on in the past. We looked at financing a deal with Cabbage, and we just weren't as happy with their fee structure. But, you know, I just think the more that they're competing, there's some big, powerful players that want to be able to finance the micro private equity deals and small businesses, and they're going to be competing, and that's what we need. You know, now the PayPals, the Stripes, the Cabbages, Oxy, there's just some other things that I'll be talking about. Now all of these things are becoming more and more attractive as they compete with one another. Thanks for watching the video, and I'll be back with you guys soon.